Okay, and we are rejoining our chat with Bruce Kovner. Thanks to Jack D. Swagger for the original interview and for the book, of course, Market Wizards. And where I left off, it was actually kind of apt for us Hetskins. We was talking about breakouts. Um, so I think here we go. Last bit of what Bruce was saying. And this is Jack's question. It sounds like you are saying that the less explanation there is for a price move occurring, the better it looks. And well, I do think that the more of a price pattern is observed by speculators, the more prone you are to have false signals. The more a market is the product of non-speculative activity, the greater the significance of technical breakouts. Has the greatly increased use of computerized trend following systems increased the frequency of false technical signals? I think so. The fact that there are billions of dollars out there trading on technical systems that use moving average or other simple pattern recognition approaches help produce many more false signals. I have developed similar systems myself so that I can tell when that other systems are going to kick in. If it's clear that prices are moving because these billions are kicking into the market, it is a lot less interesting than if a breakout occurs because the Russians are buying. Let's say you do buy a market on a upside breakout from a consolidation phase, and the price starts to move against you. That is back into the range. How do you know when to get out? How do you tell the difference between a small pullback and a bad trade? Whenever I enter a position, I have a predetermined stop. That is the only way I can sleep. I know where I'm getting out before I get in. The position size on a trade is determined by the stop, and the stop is determined on a technical basis. For example, if the market is in the midst of a trading range, it makes no sense to put your stop within that range, since you are likely to be taken out. I always place my stop beyond some technical barrier. Don't you run into the problem that a lot of other people may be using the same stop point and the market may be drawn to that stop level? I never think about that because the point about a technical barrier, and I've studied technical aspects of the market for a long time, is that the market shouldn't go there if you are right. I try to avoid a point that floor traders can get at easily. Sometimes I may place my stop at an obvious point if I believe that is too far away or too difficult to reach easily. To take an actual example, on a recent Friday afternoon, the bonds witnessed a high velocity breakdown out of an extended trading range. As far as I could tell, this price move came as a complete surprise. I felt very comfortable selling the bonds on the premise that if I was right about the trade, the market should not make it back through a certain amount of a previous overhead consolidation. That was my stop. I slept easily in that position because I knew that I would be out of that trade if that happened. Talking about stops, I assume because of the size that you trade, your stops are always mental stops, or is that not necessarily true? Let's put it this way. I've organized my life so that the stops get taken care of. They are never on the floor, but they are not mental. What eventually tells you that you are wrong on a major positional trade? Your stop point will limit your initial loss, but if you still believe in the fundamental analysis underlying the trade, I assume that you'll try it again. If you're wrong about the general direction of the market, won't you take a series of losses? At what point do you throw in the towel on the trade idea? First of all, a loss of money itself slows me down, so I reduce my positions. Secondly, in the situation you describe, the change in the technical picture will give me second thoughts. For example, if I am bearish on the dollar and a major intermediate high has been penetrated, I would have to reevaluate my view. Earlier, you mentioned that you had developed your own trend following system to provide an indicator of where the large amount of money managed under such systems could be expected to hit the market. Do you use your own trend following systems to trade any portion of the money you manage? Yeah, about 5%. Is that the level of confidence of your confidence? I guess it's not negative 5%, so it could be worse. Overall, my systems make money, but they have volatility characteristics and problems related to risk control that I don't like. But since they offer diversification for my other trading, I use them to a small degree. Um, do you feel it's possible to ever develop a system that would do as well as a good trader? I think it is unlikely because the learning features of such a system would have to be very highly developed. Computers are good at learning only where there are clear hierarchies of information and precedent. Uh, for example, expert systems for medical diagnostics are very good because the rules are very clear. The problem with developing expert systems for trading is that the rules, quote unquote, of the trading and investment game keep on changing. Uh, I have spent some time working with expert system developers, and we concluded that trading was a poor candidate for this approach because trading decisions encompass too many types of knowledge, and the rules for interpreting the information keep on changing. Does the fact that you are trading to so much greater size than you did in your early years make it more difficult? There are far fewer markets with sufficient liquidity for the optimum size of my trades. Yep. How much money are you currently managing? Over $650 million. I assume more than half of that is due to capital appreciation. Yeah, last year profits alone were about $300 million. What are some markets that you really have trouble trading because of insufficient liquidity? An example of a market I like a great deal, but in which the liquidity is often poor, is copper. In copper, I am now the elephant. What kind of size can be moved comfortably in a market like copper before it becomes a problem? I would say in a day you can comfortably move 500 to 800 contracts uncomfortably, somewhat more than that. But the daily volume of copper is currently only 7,000 to 10,000 contracts, and a lot of that is local trading or spreads. In contrast, in the T-bond market, you can move 5,000 contracts without a problem. You can also move very large size in the interbank currency market. Can you trade a market like coffee, which doesn't have deep liquidity, but sometimes can develop enormous trends? Yes, I did trade coffee last year and made a few $1 million in it. Now, if I'm managing 600 million and I kick in $2 million in profits on coffee trades, it doesn't really matter that much. In fact, it could even be counterproductive since the time and energy I spend concentrating on coffee diminishes my focus on the currency markets, which I trade far more heavily. It would appear that you have reached the size level that impedes your trading performance. Since you have substantial personal funds, did you ever consider just trading your own money and avoiding all the related headaches in managing money? Yes, but there are several reasons why I don't. Although I invest a great deal of my own money in my funds, the portion of my funds that is managed money represents a call, which is an analogy to an option that has unlimited profit potential in the event of a price rise, but risk limited to its cost in event of a decline. I don't say this to be flippant, since my reputation among my investors is extremely important to me. But a call is much better positioned in a symmetrical win-lose position. Is there a practical limit to the amount of money you can manage? In most commodity futures markets, there certainly is. However, in currencies, interest rates, and a few commodities such as crude oil, there are limits, but they are really very high. I plan to very carefully manage the future growth in the size of funds I'm managing. When you put in orders in markets that are not among the most liquids, in other words, not T bonds or the major currencies, do you find your orders actually moving the market? They can, but I never bully a market. Talking about that, one often hears stories about very large traders trying to push the markets up or down. Does that work? I don't think so. It can be done for the short term, but eventually it will lead to serious mistakes. It usually results in arrogance and a loss of touch with the underlying market structure, both fundamentally and technically. The traders that I know who bought too highly of their ability, who thought too highly of their ability and tried to bully the market, ultimately made the mistake of overtrading and went under. Without mentioning any names, can you provide an example? There's a recent example of a British trading organization getting into serious trouble after they tried to corner the crude oil market. At first, they succeeded, but then they lost control and crude oil prices fell by $4. What was the end result? They lost about $40 million and the organization is in trouble. You are probably managing more money than any other futures trader in the world. How do you handle the emotional strain when you hit a losing period? The emotional burden of trading is substantial. On any given day, I could lose millions of dollars. If you personalize these losses, you can't trade. Do the losses bother you at all anymore? The only thing that disturbs me more is poor money management. Every so often, I take a loss that is significantly too large, but I never had a lot of difficulty with the process of losing money, as long as losses were the outcome of sound trading techniques. Lifting the short side of the July November soybean spread was an example that scared me. I learned a lot about risk control from that experience. But as a day in, day out process, taking losses does not bother me. Did you have any losing years? Yep. In 1981, I lost about 16%. Was that due to errors you made or the nature of the market? It was a combination of the two. My main problem was that it was in the first major bear market in commodities I had experienced, and bear markets have different characteristics than bull markets. What was it a matter of becoming complacent about markets always being in an uptrend? No. The problem was that the principal characteristic of a bear market is very sharp down movements followed by quick retracements. I would always sell too late and then get stopped out in what subsequently proved to be part of a wide swinging congestion pattern. In a bear market, you have to use sharp counter trend rallies to enter positions. What other mistakes did you make that year? My money management was poor. I had too many correlated trades. What was your confidence? Was your confidence shaken at all that year? Did you go back to the drawing board? I went back and designed a lot of risk management systems. I paid strict attention to the correlations of all my positions. From that point on, I measured my total risk in the market every single day. When you trade currencies, do you use the interbank market or the futures market? I only use the interbank market unless I'm doing an arbitrage trade against the international monetary market. The liquidity is enormously better. The transaction costs are much lower, and it is a 24-hour market, which is important to us because we literally trade 24 hours a day. What portion of your trading is in currencies? On average, about 50 to 60% of our profits come from currency trading. I assume you're also trading currencies beyond the 5 that are currently actively traded on the IMM. We trade any currency that is highly liquid. Virtually all the European currencies, including including those of the Scandinavian countries, are all and all the major Asian currencies and the Middle Eastern currencies. Crosses are probably the most important trading vehicle that we use that you can't trade on the IMM. Crosses are a trade involving two foreign countries. For example, buying British pounds and selling an equal dollar amount or Deutschmark is a cross. You can't trade crosses on the IMM because they have fixed contract sizes. But you could do a cross on the IMM by adjusting the ratio of the number of contracts between the two currencies to equalize the dollar value of each position. But it's much more exact and direct to use the interbank market. For example, Deutschmark British pound and Deutschmark Japanese yen crosses are highly traded and very active. In situations where a surprise news development or the release of an economic statistic comes out of line with expectations and causes a sharp price response in currencies, does the interbank market react less violently than the futures market? Or do the arbitrages keep the two markets tightly linked? Yeah, the two markets are well arbitraged, but those are the moments when a very swift arbitrager will make some money. The markets do get a little bit out of line, but not a lot. What percentage of bank market trading represents commercial activity or hedging vis-a-vis speculative trades? The Fed has done a study on that. I don't have the figures on hand, but it's basically a hedging market. The banks are the principal speculators, as well as a few players like myself. Is there a reason why the futures market hasn't been able to capture a larger percentage of world currency trading? The currency futures market is not efficient in several of the most important respects. First, hedging usually has a specific dollar and date requirement. For example, if I need to hedge $3.6 million for April the 12th, the bank just takes it. The futures market, however, trades only for specific dates and fixed contract sizes, so the hedger is not precisely covered. So actually, there's no way the futures market can compete because the interbank market can tailor a hedge for any customer. Yeah, that's right. In addition, the activity takes place within normal commercial banking relations. That is, very often the hedger wants to show his banking interests that he has a locked-in profit so he can borrow against it. Can you talk about your fundamental analysis method? How do you determine what the right price for a market should be? I assume that the price for a market on any given day is the correct price. Then I'll try to figure out what changes are occurring that will alter the price. One of the jobs of a good trader is to imagine alternative scenarios. I try to form many different mental pictures of what the world should be like and wait for one of them to be confirmed. You keep trying them on one at a time. Inevitably, most of these pictures will turn out to be wrong. That is, only a few elements of the picture may prove correct. But then all of a sudden, you will find that in one picture, 9 out of 10 elements click. That scenario then becomes your image of the world reality. I'll give you an example. The Friday after the October 19th stock market crash, I had trouble sleeping, which is really unusual for me, but I am sure I wasn't the only trader to lie awake that night. All week long, I struggled with how the events of that week were going to impact the dollar. I was trying on different visions of the world. One of these pictures was total panic. The world coming to an end financially. In this scenario, the dollar becomes the safest political haven, and as a result, there could be tremendous rise in the dollar. In fact, on Tuesday of that week, the dollar did rise dramatically as many people withdrew their money from other places. During the next 3 days, there was tremendous confusion. By the end of the week, the dollar has started to give ground again. It was then that it all coalesced in my mind. It became absolutely clear to me that given the combination of a need for a stimulative action dictated by the tremendous worldwide financial panic, the reluctance of the Bank of Japan and German Bundesbank to adopt potentially inflationary measures, and the continuing wide US trade deficits, the only solution was for the Treasury Secretary Baker to let the dollar go. Someone had to play the stimulated role, and that someone would be the United States. As a result, the dollar would drop, and it would not be in the interest of the other central banks to defend it. I was absolutely convinced that was the only thing that Baker could do. You realized all of this late Friday. Was it too late to take action in the markets? Yep. And it was a very tense weekend because I realized that the dollar might open sharply lower. I waited for the Far East markets to open Sunday night. Do you do a lot of your trading outside of US hours? Yes. First, I have monitors everywhere. I go in my home, in my country home. Second, I have staff on duty 24 hours a day. Is your staff instructed to alert you immediately in case something big happens? Absolutely. First of all, we have call levels in every currency. If a currency breaks out of a range that we have previously identified, my staff is under instructions to call. How often do you get calls in the middle of the night? I have an assistant trader, and the joke is that he is allowed to wake me up at home twice a year. But it really isn't necessary very often. Whenever the markets are busy, I know what is going on all the time. My home is fully equipped with trading monitors and direct lines. Also, my assistant's job is to be up and get the calls. He probably gets called 3 or 4 times a night. Are you saying that you delegate the decision making? We create a scenario for every currency at least once a week. We define the ranges we expect for each currency and what we will do if it breaks out of these ranges. So your assistant knows that if currency X gets to 135, he should buy it or sell it. Those decisions have been made beforehand, but they are under instruction to call me if the Prime Minister resigns, or if there's a major unexpected currency revaluation, or something else happens to invalidate the recent scenario. Are there times you end up trading at night? Yep, a lot. You obviously can't trade around the clock. How do you structure your time to balance your work versus your personal life? I generally try to keep my trading confined between 8 a.m. and 6 or 7 p.m. The Far East is very important. And if the currency markets are very active, I will trade the Far East, which opens at 8 p.m. The AM session in Tokyo trades until 12 p.m. If the markets are in a period of tremendous movement, I'll go to bed for a couple of hours and get up to catch the next market opening. It is tremendously interesting and exciting to see the wave roll from country to country. Absolutely. When you are really involved, the screen almost reaches out and grabs you. The way the quotes are made changes. They get wider, they get wilder. I have contacts all over the world in each of these markets, and I know what is going on. It is a tremendously exciting game. There are opportunities all the time. Forgetting trading for a minute, one of the reasons that I am in this business is that I find the analysis of worldwide political and economic events extraordinarily fascinating. The way you describe it, you make the whole process sound like a constant game rather than work. Do you really look at it that way? Um, it doesn't feel like work, except when you lose. That is, then it feels like work. For me, market analysis is like a tremendous multi-dimensional chessboard. The pleasure of it is purely intellectual. For example, it is trying to figure out the problems the finance minister of New Zealand faces and how he may try to solve them. A lot of people will think that sounds ridiculously exotic, but to me, it isn't exotic at all. Here is a guy running this tiny country, and he has a real set of problems. He has to figure out how to cope with Australia, the US, the labor unions that are driving him crazy. My job is to do the puzzle with him and figure out what he's going to decide and what the consequences of his actions will be that he or the market doesn't anticipate. That to me in itself tremendous fun. In following all these varied world markets, I know you read a tremendous amount of economic literature. Do you also pay attention to the various market advisory letters? I get a guru report every day. Who is on that list? All the newsletters writers who have a large following. People like Prechter, Zweig, Davis, Alades, and so on. Do you use your guru report as a measure or contrary opinion? I try not to be too much of a wise guy because during major price moves, they will be right for a portion of it. What I'm really looking for is a consensus that the market is not confirming. I like to know that there are a lot of people who are going to be wrong. So if you see that most of the members on your guru list are bullish at a time when the market is not moving up, and you have some fundamental reason to bearish, you will feel stronger about the trade. Yep, much stronger. Do you think people can trade profitably just by following the gurus? Probably, but my impression is that to make money, you have to hold a position with conviction. That is very difficult when you are following someone else. There are some good gurus. However, for example, in the stock market, I like Marty Zweig. He uses excellent risk control. And unlike some other gurus, he doesn't believe he is predicting the future. He is simply observing what is happening and making rational bets. You talk about the importance of risk control and the necessity of having the conviction to hold a position. How much risk do you typically take on a trade? First of all, I try very hard not to risk more than 1% of my portfolio on any single trade. Secondly, I study the correlation of my trades to reduce my exposure. We do a daily computer analysis to see how correlated our positions are. Through bitter experience, I've learned that the mistake in position correlation is the root of some of the most serious problems in trading. If you have 8 highly correlated positions, then you are really trading the one position that is 8 times as large. Does that mean if you are bullish in both the Deutschmark and Swiss franc, then you decide which one you like better and place your entire long position in that currency? Yeah, that is definitely true. But even more important is the idea of trading a long in one market against a short in a related market. For example, right now, I am net short the dollar. I am long the yen and short the Deutschmark. In all my trading, if I'm long something, I like to be short something else. Do the cross rates like the Deutschmark, Japanese yen move slower than the individual currencies themselves? Not necessarily. For example, recently the sterling mark cross rate was in a year-long congestion between approximately 2.96 and 3.0. It finally broke out about a month ago. The day it broke out, it challenged the top of the range about 20 times. The Bank of England kept on defending it. Finally, the Bank of England gave in. As soon as cross rate pierced the 301 level, there were no trades. In fact, there was no trades until it hit 303. So it moved virtually a full 1% without trading. Is that unusual for the interbank market? Extremely unusual. It meant somebody was watching the 3.0 level. Once everyone realized that the Bank of England was not stepping in, no one wanted to be a seller. Is that type of breakout, a violent and quick one, much more reliable than a typical breakout? Yep, much more reliable. Even though your fills are worse, terrible, terrible fills. The worse the fills are, the better your trade. In this case, after trading for a couple of hours between 304 and 302, the rate went straight up to 311. Do you believe that the cross rates provide better trading opportunity in currencies than net short or long positions against the dollar? Yes, because there are a lot fewer people paying attention to the cross rates. The general rule is the less observed, the better the trade. Yeah. Actually, I'm going to make this a part 3. It's got a few more pages to go, Bruce. He's a bit of a talker, it seems like. So, yeah, we'll make this a 3-part video on Bruce. So, yep, I'm going to end it right now. Peace, Balaji.